Retail trading logic often relies on a simple trigger. If price clears a previous swing high, the market assumes upward momentum is guaranteed to follow. However, a high percentage of these breakouts lack the underlying order flow necessary to sustain a trend. Without volume support, these moves are often hollow, stalling within minutes of the initial break. These scenarios occur when market makers utilize the predictable influx of retail buy orders at a breakout level to fill their own sell-side inventory. This process harvests available liquidity before forcing a reversal in the opposite direction. In this diagram, the breakout point is inundated with buy orders. Once that liquidity is absorbed, the lack of follow-through leads to an aggressive reversal. Technical momentum is the result of synchronization across multiple data layers, specifically where price structure, moving average states, and underlying velocity align simultaneously. For an institutional algorithm to confirm a move, it requires alignment across the structural ribbon, the uncoiling of moving averages, and a specific shift in subchart velocity. To understand how these trends are generated, we will decode 3 specific anomalies from the DRW algorithmic framework: the True C, the Golden C, and the Double True C. Identifying these mathematical conditions allows a trader to distinguish between noise-driven price action and the moments when institutional algorithms are actively scaling into a position. A verified momentum continuation must pass a requirement known as the algorithmic purity filter. The first condition is structural invalidation. This requires the internal moving averages to completely exit a state of consolidation and friction. When price is range-bound, the 8, 13, 21, and 55 period moving averages tangle in a dense cluster, indicating a high friction state. A true C wave requires these lines to uncoil and fan out into parallel trajectories, proving the friction of consolidation has cleared. The second requirement is the velocity cross, tracking the speed of expansion relative to the pullback. On the subchart, the momentum histogram must snap from a decaying pullback color and cross forcefully over the zero baseline into high-volume trend colors. The timing is specific. The structural uncoiling of the averages and the histogram's velocity cross must occur on the exact same price candle. When these two systems lock together, the algorithm identifies the move as a confirmed true C wave. Mechanically, this proves that short-side liquidity has been neutralized and institutional accumulation is finished, clearing the path for further expansion. Traders use this setup to target a one-to-one mathematical extension of the prior move, executing immediately upon the close of the signal candle. Without this simultaneous alignment of structure and velocity, a price breakout must be treated as a potential trap. While the True C focuses on speed, the Golden C wave is designed to isolate deep-value entries with asymmetric risk. This anomaly relies on harmonic convergence, the intersection of 3 independent technical matrices at a single price point. By forcing separate tracking systems to land on the same coordinate, the setup mathematically isolates the point of highest probable support. The first matrix is the deep structural floor. Price drops through the fast-moving averages and collides with the 55-period macro shield line.
The second matrix requires geometric depth, calculated as a ratio of the original trend's origin. Here, the Fibonacci grid identifies a precise zone between the 61.8 and 78.6% retracement levels. The third matrix is a quantitative support level, typically a high-volume institutional price block. At convergence, the 55 EMA, Fibonacci zone, and quantitative level align. Price touches this intersection, immediately leaving a sharp rejection wick. Institutional algorithms recognize this price cluster and deploy large limit buy orders to defend the line, resulting in an explosive price response. This structural floor provides an exact coordinate for an ultra-tight stop-loss, placed just beyond the 55-period baseline. The result is an asymmetric execution profile, often yielding a risk-to-reward ratio of 1:5 or higher. Overlapping these independent data sets provides a structural basis for identifying low-risk entry points, turning a standard pullback into a high-confluence price floor. In a vertical runaway trend, many traders attempt to short the market because price appears overextended on their screen. Standard mean reversion logic fails in these conditions because the underlying mathematical drivers have shifted into a runaway state.
This state is created by macro-micro gear synchronization, where two different timeframes lock into alignment. On the left, the macro timeframe confirms a major trend ignition. Simultaneously, on the right, the micro timeframe reaches its standard target extension. Instead of reversing at the micro target, price moves sideways, refusing to close below the fast 8-period velocity line. The signature of this anomaly is found in the momentum histogram, which reveals whether sellers are gaining any traction. The histogram bars pull back toward the zero line, but they bounce off the baseline and launch a secondary expansion wave instead of crossing into negative territory. This indicates a liquidity vacuum, where limit sell orders have been removed, allowing the market maker algorithms to chase price vertically. In this environment, the rule is to never short the trend. Risk is managed by trailing stops behind the intermediate 13-period moving average. When macro and micro gears synchronize, algorithmic trend-chasing forces override standard exhaustion patterns, creating a compounding runaway effect. These three frameworks form a unified taxonomy for identifying and trading institutional momentum. Each anomaly provides a specific modular tool for different market states, using ribbon and histogram signatures as objective evidence. The true C wave serves as the validation of structural velocity, requiring parallel averages and a clean zero-line cross. The golden C wave identifies deep value confluence, where the 55 EMA and Fibonacci levels intersect to provide a high confluence entry. The Double True C tracks runaway compounding, using the zero baseline bounce to identify when a trend has entered a multi-timeframe vertical state. Retail failures often stem from relying on subjective patterns that are easily manipulated by larger market participants. Institutional execution, by contrast, utilizes rigid data confirmation rules to ensure that every single position is backed by complete mathematical synchronization. Capitalizing on momentum requires moving past visual chart patterns and waiting for the specific data signatures that indicate institutional trend generation.